Welcome to the Property Investment Podcast. Today's episode focuses on the state of the global economy and achieving investment value in an overpriced and low interest rate environment, where inflation is a real threat to the value of a dollar. I hope you enjoy the episode. In an environment where we have been fortunate to be the benefactor of significant and ongoing government stimulus and an economic cushion amid COVID, a question mark sits over the longer-term value of cash. As with anything, when currency supply is increased significantly, value maintenance of the dollar over the long term can be an issue. Couple these high levels of liquidity with the lowest interest rate environment ever experienced in our lifetime, and it's the perfect environment for sharpening of asset pricing across the board. Where it could be said that in the past cash is king, as we hit the strides of this new economic frontier, what is underpinning the value of that cash and cash flow in an investment portfolio becomes more important than the cash itself. MP Funds Management has recently co-invested into the acquisition of an 18,000 square metre approximately A-grade commercial office building in Brisbane CBD, with the total forecast return in the low double digits. The attributes of the deal that drew us to making an investment decision are largely defensible ones and are reflective of the current times. With a long weighted average lease expiry to 2028-29 and 90% of the building income underwritten by Australian government and AA rated insurance tenants, annual rental increases are set at 3.5% and 3.75%. The passing acquisition cap rate is reflective of a 5.5% yield, which, when geared to 55%, is a notional average annual distribution of 7 to 8% over the term, representing strong cash flow. On undergoing detailed due diligence of the asset, some of the attributes we were drawn to were that the building was largely under-rented, meaning that rents are below current market values. Brisbane CBD is undergoing a $52 billion infrastructure spend transformation, and the building itself underwent a complete refit in 2017, bringing it to A-grade standard and a 5-star green and neighbours rating. On a rate per square metre basis, the acquisition value is reflective of replacement cost, which is a good check and balance as a rule for value. From a relative value and income perspective, the 5.5% acquisition cap rate at the subject property as a result of being located in Brisbane is compelling when compared to markets like Sydney or Melbourne, where comparable assets would trade for cap rates of approximately 4.25%. The benefit of this is that when geared conservatively, taking advantage of the low interest rate environment, the resulting cash from the defensible rental stream yields a more compelling investor distribution than comparable buildings in Sydney or Melbourne. When assessing the incumbent tenancy base, the economic structure of the leases relative to the market and the practical attributes of the building itself make it a compelling long-term accommodation solution for the incumbent tenants beyond the lease expiries in 2028 and 29. All in all, the asset represented an outstanding risk-adjusted return and robust defensible income stream with a high probability of outperformance in the current market conditions. Whilst commentary focuses on the immediate work from home argument, a few things have been missed in that commentary at an economic and practical level. Most that work from home are not set up to work from home and don't have home offices. Leaving the house each morning to go to work to be around other people is about the importance of mental health as an employee. Of similar importance is the actual economic productivity and culture of an organisation, which requires collaborative face-to-face environments. As an example, the New York Twin Towers 9/11 disaster saw a wave of commentary that organisations would avoid high-rise commercial office. However, given the fertile and productive working environments provided by these buildings, the sentiment was forgotten, and not long after, it was business as usual. It is true that there is a huge amount of commercial office sublease space coming to the market, but the current dynamic will also mean a stop to new supply as companies refrain from committing to pre-lease space in new buildings. What this means is an immediate flight to quality, a short-term dislocation primarily in the B-grade sector, an increase in incentives across the board, but ultimately a cap on new supply which will ensure the ongoing value of face rents as the economy recovers. A December 2020 Jones Lang LaSalle research report highlights a survey conducted of 38 leading global investment groups. The result of that survey indicates 50% of those investment groups are seeking to increase their investment exposure to Australia. So what does this mean for Australian investment grade real estate values? With our investment grade real estate assets representing the highest yields available globally, our transparent governance and our strong economy and stable political environment, our relative isolation from the rest of the COVID-affected world is increasingly attractive, creating a more competitive environment for local assets and putting upward pressure on pricing as a result. From an investment perspective, achieving compound growth in a sharply priced market, as we are in now, is more difficult than in a market with lower pricing. Head over to the MP Report Premium for the full interview with Michael Rothner, Principal of Ash Morgan. Ash Morgan have provided investment funding for over $10 billion of premium investment grade real estate assets over the last 40 years. And Michael talks through the group's lessons as they traded through the GFC and COVID. Also coming up on the MP Report Premium is a detailed discussion with Ian Hetherington, who is arguably the leading commercial office agent in Australia. With average transaction sizes of 300 to 400 million and a range of 100 million to 1.5 billion, Ian gives a broad and detailed overview of the Australian national commercial office markets with a deep dive into Sydney, Brisbane and Melbourne pricing, key drivers for each of those markets, and value and risk across premium A grade and B grade. For exclusive visibility into the MP Funds Management past deal analysis and co-investment deal flow, sign up to the MP Report Premium. MP Funds Management has provided investment funding for over $1.3 billion in investment grade real estate transactions. These transactions have produced an average annual return of 22%, with the lowest being 9% and the highest being 45%. With MP Report Premium, you can expect exclusive visibility into co-investment opportunities with MP Funds Management, in-depth analysis of completed deals, detailed market analysis, and premium interview content. Sign up to the MP Report Premium via the MP Report website.